It looks like everybody found the same excuse to sell their stocks. Same old reasons as always. The Federal Reserve taking away the punch bowl and geopolitics. And the patient, formerly known as a 10-year treasury, looks like it may have broken its high fever at around 200 basis points, which makes a big, interesting setup for the Federal Reserve this month as they're about to show us some tough love. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills. I hope you're having a great year. I'm going to do a little report card here on some of the major indexes we follow as we get into things. The Dow Jones off its 52-week high about 8%. I think it pulled out of correction territory today with a big move up. Correction territory is 10%, bear market is 20%, and I think we just popped off of correction territory. NASDAQ is in correction territory, down about 15% off its 52-week high. S&P rubbing up against it, down about 9%. Oil is sitting at a 12-year high. As I've discussed oil in the past, in my humble opinion, it's basically a worthless commodity that is just going to be used until we no longer have to use it. It already proved its value in the spring of 2020. It went negative, and people were being paid to store barrels of oil where they could. Oil is a diminishing product, asset, reserve, class, commodity, will be useless, but right now it's sitting at a 12-year high until we get off our need for it. Gold down about 2% off its 52-week high, and the 10-year treasury sits today with a 1.86 yield. Popped up today pretty good, about 15 basis points from yesterday's close, and its recent high was 2.06. And the last commodity class I'm going to talk about, I don't really know how to place this, but Bitcoin is really just an algorithm based on sentiment and confidence. And it's actually very surprising that Bitcoin hit a high of 68,000, which is also its all-time high, got a low of 28,000 in the last 12 months, and is currently sitting at 43,000. The reason I call Bitcoin interesting is we don't really know what it is yet, but it didn't make a lot of sense to me when the stocks were selling that people were also selling their Bitcoin, because Bitcoin still hasn't figured out its place in society, but it's certainly not the place of the stock market. The only thing I can believe is that the same people investing and moving the stock market up and down are also investing in the same mentality with Bitcoin. That's why it seems to follow the Dow and the Dow futures. I think there is going to be a major disconnect in the near future between Bitcoin and all other commodity classes, as it will just work as a hedge of sorts against anything at any time, because what is Bitcoin? It's an algorithm based on confidence. All right, we're taking a peek at some of the old themes that I really got sick of last year, but I'm going to touch on them. Shipping and logistics, huge problem for everybody. I've heard some of the numbers showing a tenfold increase in the price to ship goods back and forth across the seas and oceans. I have an idea. Why don't we start making stuff here domestically, or maybe on this continent for that matter, and we won't have those issues anymore. That also leads into the supply chain issues, which is basically the main cause of the inflation we've seen. I think supply chain, if we can bring it a little closer to home, maybe, hopefully, can figure itself out, because it has been the leading cause of this inflation that I believe is indeed actually here to stay, but it will taper off. Inflation in luxury cars like Lamborghinis and Bugattis, no one really cares about that. The people buying those things, inflation doesn't matter. They have no economy. They are cash buyers at all times with basically no limits. The inflation I'm talking about is when you go to the grocery store and you walk out and you're carrying that bag. It always seems to get, with each trip, week by week, a little lighter and a little bit more expensive. I think that is here to stay. It should taper off, but we will see. And jobs. I love jobs. I love when we make jobs. I also find it interesting when we don't make jobs because of the Great Resignation. A lot of people have quit their jobs and haven't come back. We have a big jobs report coming out this Friday. The Federal Reserve's meeting in 2 weeks. They're going to take a lot of cues, I bet, from that jobs report and the underlying numbers showing strength in the economy or weakness. But I do know this, the JOLTS number, the job opening labor turnover survey number, basically the job openings number, it is still at 10.9 million as of last look, which is very high. one thing that we should start calculating is, I don't know if this exists or not, but I mentioned it last year, a job quality index. Of all these job openings, how many of them are actually careers and how many of them are jobs that you could be replaced or you could replace them at the drop of a hat? So I think the job quality index, if it exists, great. If it doesn't, we should look at it because I think people want careers rather than jobs. And we are going to be looking big at that this Friday and look for the Federal Reserve to take their cues from there. Now, moving on. Interest rates on mortgages, as we all have heard, have gone up. The 10-year Treasury is not that much higher than it was when I last did this show in the middle to end of October, sitting around 163 back then. As you know, we're sitting around 186 right now, but the mentality behind the mortgage-backed securities is a wait and see, so rates have gone up. So I'm going to talk about housing, interest rates, and the cost of money, and most importantly, affordability. So let's say you borrow $1 million for the last couple of years at 3% on a 30-year fixed loan. That payment is $4,216. Let's say rates go up to 4%, for example, on a 30-year loan. That payment is $4,774. Now, let's move up to a 5% where we were a decade ago, a little bit more now, actually. 5% on $1 million on a 30-year fixed is $53.68 a month. So as we see, for each percent in interest rate on $1 million, it's a safe $500 up in monthly cost. The change from 3% to 5% is about $1,100, $550 I should say on that previous number, but about $1,100 higher. So this $1,100, when you calculate it out to how we do these mortgages, you basically need to make another $2,500 a month or $30,000 a year to be able to afford that same money. So, that said, as we see rates, they're sitting somewhere between this 3 and 4% level. As we see rates sitting here, it's not going to have a huge effect on housing prices and on demand for that matter, because affordability is still in play. It's not until we get to the 4.5%, 5% range on your everyday good old-fashioned 30-year fixed loan that the paradigm will shift and we will have to see something adjust, whether it be housing prices come down a tad bit or new buyers that were in one realm step up into the other realm to kind of even things out. But the way mortgage rates sit today, affordability is still there. And the most important part of this mortgage market is liquidity is still there because the mortgage paper still now, the defaults are within a minute margin of error for that matter. Mortgage paper is safe. The housing market is safe. Okay, well, I'm glad you could join me today. Haven't done this show for a little while. I am back. I think I'm going to be back at it every week for that matter. If you have any questions about your mortgage or anything real estate related, please don't hesitate to reach out to me. Thanks so much. Have a great week.